So a great place to start this week, if we're going to spend all week talking about index funds and index investing, is to really nail down what index investing is. Okay, so index investing in its simplicity, right, is utilizing a passive investment strategy that requires a manager to only ensure that a fund's holdings match those of a benchmark index. Okay, so with index investing, all that's going on is that some fund manager is saying, let me do exactly what an index does. Let me invest exactly like an index invests. The manager is not choosing anything by their own discretion. They're not doing any research and trying to figure out if one thing is better than another, one stock's better than another, a bond's better than another. They're not trying to do any of that. What they are trying to do is simply say, what is this index doing? And let me set up my portfolio with the exact same weights into the exact same investments as this particular index, whatever index it is that they are trying to track, right? One of the most common indexes that we try to track and that I reference quite a bit on this show is the S&P 500 index. And that's just because that is one of the most commonly used benchmarks for the American stock market. And so if you buy an S&P 500 index fund, you are literally buying a mutual fund that will track the S&P 500 exactly. It will literally do what the S&P 500 does. So index investing is very, very simple, right? It doesn't require a whole lot of work. Typically, index funds are cheap as far as costs to investors, and they are widely available. They're widely available in the form of mutual funds and ETFs. A lot of people have taken advantage of the availability of ETFs in the market to invest in different indexes. And so that can be a way that you do that as well. But they were initially created in the form of mutual funds that just tracked an index. And the creator of the index fund, the individual who had the idea and put it into play for the index fund, was John Bogle, otherwise known as Jack Bogle. And Jack Bogle, he was the founder of the Vanguard Group. And for those of you who don't know what the Vanguard Group is, just go online and type in Vanguard, right? And they're one of the largest investment companies in the world today, one of the largest mutual fund providers, and have more assets under management than just about anybody out there. They run right alongside the Fidelities and the Schwabs and the Merrill Lynches of the world when it comes to asset management. But what they really push is index investing, because that was Jack Bogle's primary objective, was low-cost index investing. Bogle revolutionized the mutual fund world by creating index investing, which allowed investors to buy mutual funds that track the broader market. He did this with the overall intent to make investing easier and at a low cost for the average investor. So the fact that transaction costs are almost zero now, the fact that there are several different index funds and mutual funds that have 0% expense ratios, you can thank Jack Bogle for that. He was all about low cost investing for the average individual. Okay. So Bogle introduced the Vanguard 500 fund, which I actually have money in the Vanguard 500 index fund, which tracks the returns of the S&P 500, and he marketed the first index fund to retail investors, which is a really big step in the investing world because, as we even know today, institutions take up a lot of the trading volume. Institutions do a lot of the trading out there and a lot of the investing out there, and if you don't have the right connections or the right amounts of money, then getting your money invested with those institutions may be quite difficult. But to have the retail investor have more power is what Jack was about. And he definitely made it so with the introduction of the index fund. Okay, one of his pioneering achievements was low-cost investing in mutual funds by creating what we now call no-load funds, which means, back in the day before there were just expense ratios, right? Expense ratios being a percentage of assets under management that you must pay annually, that comes out of your account annually because you're invested in some mutual fund or ETF or something of the like, right? Before that was just the case, there were also loads, and a lot of mutual funds still have loads today, but the vast majority are no load funds because of the pioneering work of Jack Bogle. And a load was either on the front end or the back end, and it was some amount that you had to pay either at the buy or at the sell or both of the mutual fund that you were purchasing. And he said, let's just get rid of that. Let's make investing cheaper. Okay. And so he really pioneered a lot of things that we are using today and that we are using in large amounts today. I mean, a couple years ago, the big talk was, is index investing just getting too huge? Is index investing, just way too large and crazy? And, the story flips a lot of times in markets, because today they don't talk as much about index investing and it being some type of issue, because so many individuals, so many retail investors have moved into the space of investing in individual stocks on things like Robinhood and investing in a lot of things they don't understand. But there's still a lot of passively managed money in index funds, and that's something that index funds are well known for, is their passivity. Right? They are passive investments by trade, because they are not trying to actively beat some index. They are only trying to keep up with exactly what an index does throughout time, which can provide you with very good returns at a very low cost. Okay, so that's what index funds are. That's who Jack Bogle was. That's what he was about.